RIN TV coverage of the 2015 Joint Industry Forum is brought to you by PCS, a unit of Verisk Analytics. Late last year, Tom Leonardi left his post as the Connecticut Insurance Commissioner to join Evercore Partners, an investment banking firm. We spoke with Tom during a recent visit to New York about the new Congress, capital standards, and M&A activity in the industry. Here are the highlights.
Well, the capital standards, I was a commissioner for 4 years, and they were front and center every year. We obviously have had the basic capital on the international side, the basic capital agreed to at the IAS, and that took the better part of last year, and that applies only to the SIFIs. It's a basic capital requirement. And then there's the issue of the HLA, the higher loss absorbency that would be put on top of the BCR, again for systemic companies. And I think the most important one that everyone's looking towards is the international capital standard. I've spoken on a number of occasions that I always ask, what is it that we're trying to solve with a capital standard right now, particularly when we have various different solvency regimes throughout the world. We don't have a unified accounting standard, in the IASB and the FASB. Worked for 15 years, and one of the reasons that they weren't able to ultimately agree and threw in the towel last summer was because of the valuation issue. And market consistent valuation, which is a big piece of Solvency II, and is also a significant part of what I think folks at the IAS are going to want to have in a ultimate international capital standard, I think is just the wrong way to go. I think it builds pro-cyclicality, it creates systemic risk in an industry that otherwise isn't systemic. And I think those are significant concerns that I think the industry and regulators, both here and abroad, are looking at. So those would be the key things on the international side. On the domestic side, of course, the Fed is charged with being the group-wide supervisor of the SIFIs, as well as any of the thrift holding companies. And of course, there are 4 large companies that are in that class: State Farm, USAA, Nationwide, TIA, CREF, and 2 or 3 SIFIs, depending on how Metropolitan Life's appeal goes. I think that the Fed is clearly working on those standards, but we don't know what that is. We don't really know what they're thinking at this point. And so that's of a significant concern, certainly, for state regulators and the industry. I think that there was a survey of the industry done in the last year or so, and the influx of alternative capital, whether it be cat bonds or ILS, in the property casualty market was one of the top 8 disruptive forces in the industry. And I think it's true. I think that you're seeing, we have about 25 billion, I think is the number of ILS and cat bonds outstanding right now. Over 8 billion were issued this past year in 2014, which was a record. I understand the alternative, the investors, and particularly pension funds, are looking at this as an uncorrelated asset class. With relatively high yields in a very prolonged, artificially low interest rate environment. And so it's attractive from those standpoints. From a reinsurer standpoint, there is certainly a concern about the risks that the ILS was paying 6.5–7% yields on 4 years ago. Those same risks are now generating 3.5% yields. So is there any underwriting discipline? Is the target return of those alternative investors so much lower, whether it's because of tax advantages or otherwise, than the traditional reinsurance market? But the reality is there is enormous capital, and historically we've always seen the cycle go up and down, and as the cycle hardens, people start to be able to charge higher rates, and we're not going to be seeing that in this market. And of course the property cat market is one of the strongest from a profit standpoint for the reinsurance industry, so I think it's a double whammy. It's something that's of significant concern. Well, I think the thing that we have to be thankful for is that Congress did get back in session and handle the TRIA issue and ARAB 2 very, very quickly. I know it gave all of us in the industry quite a scare, but they did do the right thing and they got it done, and with a very, very strong majority. So I think that that's a positive and speaks well for Congress. Well, I think the ACA has 2 principal issues that are going to be challenges from a legislative standpoint and from a court standpoint. The first is there is a bill that's intending to change the definition of full-time employee from 30 hours to 40 hours. The problem with that, I think, is somewhat unproductive, quite frankly, because it's going to result in several hundred thousands of people who otherwise would have had coverage under the current ACA who would not. And I think that's a problem, and I think anything that erodes the basic principles and objectives of the ACA is likely, very likely, to be vetoed by the President should it get through Congress in the first place. I think the second thing is the King versus Burwell decision or case that's in front of the Supreme Court this term. In that situation, I think the Court of Appeals for the Fourth Circuit, I think it was, had ruled that it doesn't really matter whether the subsidies are paid to people who purchase through a state-run exchange versus a federal exchange. The appeal is intending to suggest that it's not appropriate for the benefits or the subsidies to be paid if you purchase through a federal exchange, and I think that's just not very likely to be overturned, but of course whenever a case goes to the Supreme Court, you never really know. So that's, those are the two, I think, biggest challenges, at least at this point in the year, and it's early, it's just January, so. Well, I think given a number of the things we talked about with alternative capital, and I think going for scale and for both product and geographic distribution, I think the opportunities in insurance M&A are as high as they have been in a long time. It certainly was one of the reasons that I was very excited about joining Evercore. The other reason I was very excited about joining Evercore is because it's just such a fine firm. It is an independent firm, which means that it's providing advice to the client and only that. It's not trying to sell various products to the client. It's never on the other side of the table from your client, and those were very important things to me. And it's got a selection or a collection of some of the absolutely best investment bankers on Wall Street, so I'm honored to be joining that group. And I think maybe the two most important things for me is that it has a culture of excellence and is built on a foundation of integrity. And from where I've come from and what I think is my reputation in this industry, it was very important for me to go to a firm that had those attributes, and so I'm very excited about joining the folks there at Evercore.
For more of our coverage of the 2015 Joint Industry Forum, visit the RIN TV On Demand Library.